What's going on, everybody, and welcome to the video. In this one, we're going to be talking about 3 covered call ETFs that do have a lot of upside potential. They have really high yields, upwards of nearly 20% dividend yields, which is insane. We'll go over, is this yield too good to be true, and everything you need to know about these covered call ETFs. So thank you for stopping by the video. If you enjoy it, make sure to subscribe to the channel and turn on post notifications so you don't miss out on any future videos. But let's go ahead and get straight into the video. So first off, the market is down pretty bad. My portfolio over the past week is down 3.6%, putting some pretty big dents into my portfolio. However, I'm not sitting here freaking out. You got to understand, as an investor, you need to learn to love the red. You need to buy when you can on these dips. And so I'll be making a video coming out on Friday on stocks that I plan on buying on the dip, and me adding cash into my portfolio so I can buy more stocks onto the dip. But let's go ahead and talk about stock number 1 on the list, which is going to be ticker PBP, Invesco Exchange Traded Fund Trust, Buy Right ETF, S&P 500. They have a dividend yield trailing 12 months of 6.28%, and on the past month, the ETF is actually down 4.8%, but it's kind of because they track the S&P 500, and the S&P isn't performing too well at the current time. The past year, though, they are up 11.02%, which is really solid. You know, that's like your average S&P 500 annual return, plus a little bit extra. You know, it's kind of more of the optimistic side of your S&P 500 average historical return, plus the 6% dividend yield, which is paid out on a quarterly basis. Now, their expense ratio is 0.49%, and they have roughly $175 million assets under management. Over the past 5 years, this ETF is up 5.78% because a lot of these higher yield and covered call ETFs, when it comes to a market crash and what we saw in COVID, it does make them just absolutely plummet. And so this ETF completely plummeted, and their slower growth makes it harder for them to recover. But talking about this stock's dividends, they have incredible grades. An A minus, A plus consecutive years of dividend payments, which is 13 years. That's incredible. They have a dividend growth record of 1 year. They did not grow their dividend because of COVID at one time. A 5-year growth rate on that dividend of 31.29%, which is insane. And as I said, they pay these dividends on a quarterly basis. Now, looking at PBP in their entire ETF strategy, it tracks the S&P 500 and uses a covered call strategy to provide long exposure to the S&P 500 and selling call options thereon. PBP writes covered calls on its portfolio. Pretty much what they do is they sell covered calls on the S&P 500, usually once per month out of in the money types of calls. And what they'll do is they'll take that income and they pay it out to shareholders, potentially speaking, you and me, and paying it out in dividends. And it does give them limited upside, but it also kind of prevents them from downside, which a lot of people are seeing right now in the market. So just looking at their top 10 sectors, we have technology being very heavy, consumer cyclicals, and financials. And then their top 10 holdings consume of some pretty solid companies like Apple, Microsoft, Tesla, Berkshire Hathaway, just a big S&P 500 big companies. And that is that. Now let's go ahead and talk about if you would have invested into PBP 5 years ago, back in 2017, you would have gotten a total return of 36% and an annualized return of about 6.4%. With your dividend reinvestment, this is assuming a $10,000 initial investment. You would have started with 460.5 shares, and then you would have ended with just below 600 shares. So your yield on cost would be sitting very, very nice. Pretty solid stuff. Now let's go ahead and talk about covered call ETF number 2, which a lot of people do talk about, and that is ticker USOI, Credit Suisse Crude Oil Shares Covered Call ETN. So this is actually an exchange traded note, which is a little different than an exchange traded fund. The yield on this thing is literally 19.69%, and they pay these out on a monthly basis. It has an expense ratio of 0.85% and $190 million in assets under management. So what this ETF tends to do is they try and provide the returns of USO, which is the United States Oil ETF. So they kind of track this index, and that's kind of like, you know, how these ETFs track the S&P 500. Well, this ETN kind of tracks the United States Oil Fund. And this is an ETN. So what we'll see is an ETN is typically issued by financial institutions and bases their return on a market index. In this example, oil. ETNs are a type of bond. At maturity, this note will pay the return of the index it tracks. However, they don't pay interest payments like a bond. So it's kind of similar to a bond without the interest payments, but instead of interest payments, because it almost trades like a stock, you're getting dividends. And it's a 20% dividend yield, which is insane. So it is potential that this thing just keeps plummeting. Because if I'm going to be brutally honest, let's go to the past 10 years on this thing. That's not good. Going from 27, 28 per share, 30 per share, all the way down to its current $5 levels. It's been at $5-ish ever since COVID. And that's not really that good. Now, that's a pretty solid dividend yield, and you might be able to be buying in at a really low price because this note will expire one day, but its maturity date isn't until 2037. So you have all this time to rack in these incredible dividend yields, which is incredible stuff. But I personally am not invested in any of these three ETFs, one of them being an ETN, and my main reason is because I don't see it placing a spot in my portfolio, and it's personally my investment horizon and goals might be a little bit different than others. Some people might be aiming for high yield, while I myself am aiming for higher growth and lower yield, aiming to get my yield on cost higher. If you're aiming for completely yield investing and you don't care if the stock price falls, you just want cash flow, this could be a good bet because over the past year alone, this is up 10.9%, which is really good returns. I mean, that's 11% returns. You can't be complaining about that. Over the past month, the ETN is up 7.5%, really solid returns, especially over a 1 month basis. That's kind of because oil has been doing pretty solid as well. I mean, if we go ahead and look at USO, which is the ETF they're performing, the past year, it's up 72.5%. In the past month alone, it is up 20%. That's incredible stuff. So they're kind of betting on oil whenever you invest in this. Looking at the dividends, they have a dividend growth record of 0 years, a yield of roughly 20%, and they pay their dividends on a monthly basis. Now, these dividends are not going to be in consecutive, like maybe 10 cents and 11 cents, 12 cents, not consecutive growth. They're going to vary. You'll see right here, 15 cents, and then right here, 7 cents, then 14 cents, and all of these different numbers, they vary because it's an ETF it's an ETN, and they're getting different income in order to make those payments. Now, looking if you invested in here 5 years ago, or whenever the fund kind of incepted, back in 2017 in April, so just below 5 years, your $10,000 initial investment would only be worth about $6,000. However, you would have collected $7,000 in dividends. So that's a lot of money. Now, looking on the total return, excluding those dividends, you would be losing some money, but you'd be sitting on a lot of shares. You would have started with 412 and ended with 1,100. You'd be getting incredible dividend income right now. Now, your yield on cost might not be the best because the fund has fallen by a lot over the past few years. But that's that. Let's go ahead and talk about ETF number 3, the final ETF on this list, which is going to be ticker RYLD, Global X Funds, Global X Russell 2000 covered call ETF. So they take Russell 2000 stocks and they sell covered calls on them. An expense ratio of 0.6%, a dividend yield of 12.77%, assets under management of just below 790 million, and a dividend frequency of monthly. Their past year performance is up 2.36%. And whenever I think of Russell 2000, I honestly think of meme stocks. Like if you go ahead and talk about what is the Russell 2000, it's a market index comprised of 2,000 small cap companies. So let's go ahead and talk about this. RYLD, they just take the Russell 2000 index and then they they sell covered calls on that index. And that index is VTWO, Vanguard's Russell 2000 index. And the top holdings and all the holdings mainly consist of things like the dollar, like cash, AMC, one of the biggest meme stocks out there with its huge squeeze, BJ's Wholesale, Tetra Tech, all of these different companies that are kind of small caps. Crocs, you can see, Chesapeake Energy Corporation, Performance Food Group. So you get these gist. It's not necessarily your big, huge moat companies that almost are too big to fail. It's a little bit of a risky index, but it still has a lot of potential because the growth can definitely be seen there. Now, the top sectors are going to be financials, healthcare, and technology. Now, looking on some more stuff on this ETF, the dividends, let's go ahead and talk about that. A dividend yield, A+, of course. Dividend growth rate, 12 months, is 24%. That's pretty solid. Dividend growth record for the past 2 years. And then what we'll see is they pay their dividends on a monthly basis, like I said. Looking on the historical dividend payments, what we'll see is it's kind of the exact same thing. You'll see kind of varies, but still pretty solid stuff. Now they just increased that dividend to 31 cents, which is really, really good. You always want to see more dividend income coming in. So right now you might be able to buy in and be getting yourself a potential good yield right now and even better yield on cost in the future. Now let's go ahead and talk about if you would have invested $10,000, it would be worth roughly 12.7 thousand now. 5 years ago, or only 3 years ago, as it was incepted in 2019, you would have collected 3.3 thousand in dividends, gotten a total return of just below 30%, annualized return of 9%. You would have started with just below 400 shares and ended with 539. So you get the gist. When it comes to investing in these, it's almost like you don't want to look at the share price. Now, you want to make sure that you're not just investing in something that's completely plummeting to the ground. You want to make sure you're investing in something that can at least stay flat, and if it falls down, it doesn't fall down that much. And of course, you want the share price appreciate, but I would say the main concern if you're going to be a covered call ETF investor is getting your shares reinvested and turning those reinvested dividends into more and more shares to make your portfolio get that huge dividend snowball and just provide more and more income. But everybody, that is what I have for you in this video. So if you enjoyed it, make sure to subscribe to the channel, turn on post notifications for all future videos, and check out my other YouTube channel talking about more risky stocks, growth stocks, and I even just keep you guys up with news like on other stocks. Like I talked about the Microsoft and Activision merger and acquisition that's going on right now. So make sure to check that channel out. I always like to see your guys' inputs and your guys' opinions. Thank you so much for making it to the end of the video, like I said, and leave a comment below. Use M1 Finance if you haven't already. Sign up with my account using my link in the description or in the pinned comment down below. You will deposit $100. I think it might be $50 right now. And then you will deposit that money and you will get a $50 free back. So you're making a huge return on your investment just like that. Free money. Make sure to go check it out and I will see you at the next video.